I've sat in front of a screen and watched my account go to zero. Not once, twice. And I kept coming back because I was convinced the market owed me something. It doesn't. It never did. And it won't owe you anything either. What you're about to hear isn't a list of clever strategies or glossy indicators. This is the brutal archaeology of failure. 10 lessons that most traders take years to learn. Years, not weeks. Not months. Years of lost capital, lost sleep, and lost confidence. The tragedy is, none of it had to take that long. Every single one of these lessons was available. In books, in seminars, from traders who'd already bled for it. But nobody listens. Not really. Because the market hasn't hurt you badly enough yet. And until it does, the words just bounce off. So today, I'm going to try to shorten your suffering. Not eliminate it. You can't eliminate it. But compress it. Because the traders who survive long enough to become consistently profitable aren't smarter. They're not luckier. They simply learned these lessons, and they learned them before the market took everything from them. Let me ask you something uncomfortable. When your last trade went wrong, and it did go wrong, because all our trades go wrong at some point, what was the first thing you did? Did you look at the chart? Did you check the news? Did you blame the spread, the broker, the algorithm, the Federal Reserve? Because I'll tell you what you didn't do. You didn't look in the mirror. I spent the first 3 years of my trading career building systems, indicator after indicator, moving average combinations that took me weeks to backtest. I had spreadsheets that would make a quant blush. And every time a system failed up its numbers, and they all failed, I went back to the drawing board and built another one, a better one, a smarter one. I was convinced the answer lived somewhere inside the data. It didn't. The answer was sitting in the chair. Here is what nobody tells you when you start trading. The market is not a puzzle to be solved. It is a mirror, and it reflects back at you, with ruthless precision, every psychological flaw you have ever had. Your impatience, your greed, your desperate need to feel clever, your inability to sit still when nothing is happening, your compulsion to act when action is the worst possible thing you could do. Every weakness you have ever carried in your life, every one will show up in your trading statement sooner or later. Most traders spend their entire careers treating this as an information problem. They buy courses. They attend webinars. They follow signals. They subscribe to analysts who speak with the confidence of people who have never actually had real money on the line. And the losses keep coming. Not because the information is wrong, but because the person receiving the information is not yet equipped to use it. Think about what happens when you enter a trade and it immediately moves against you. Not catastrophically, just a little. 40 points, 50 points. What happens inside you in that moment? There is a tightening, a voice that says, wait, give it a moment, it'll come back. And then it drops another 30 points and the voice gets louder. And suddenly you are not trading anymore. You are hoping, and hope is not a strategy. Hope is what you do when you have already lost control. That response, that freezing, that hoping, that inability to pull the trigger on a stop, that is not a market problem. That is a you problem. And it will follow you from broker to broker, from strategy to strategy, from time frame to time frame, until you decide to look at it directly. The traders who survive long enough to become dangerous are not the ones who found the perfect system. They are the ones who got brutally, uncomfortably honest about who they are under pressure. They did the unglamorous work of sitting with their own discomfort long enough to stop reacting to it. The market will teach you this, one way or another. The only question is how much it charges you for the lesson. There is a moment every trader knows. You are in a trade. It is going against you. Not violently, not yet. But it is moving in the wrong direction, and somewhere in the back of your mind a little voice whispers a seductive, dangerous idea. Add more. Bring your average down. Now you need a smaller move to break even. It feels logical. It feels like problem solving. It feels in that moment like the smart thing to do. It is the single most expensive thought in trading. I want you to understand what is actually happening in that moment. You entered a trade because you had a thesis. The market had a setup, a signal, a reason. Something told you this was the right entry at the right time. And then the market moved against you. Which means one of two things is true. Either your timing was off or your thesis was wrong. Either way, the market is telling you something. It is sending you a message in the only language it speaks, price. And instead of listening, you are arguing back. You are doubling down on an idea that the market has already voted against. That is not trading. That is a debate with the opponent who cannot lose. Paul Tudor Jones, one of the greatest traders who ever lived, said it plainly. Losers average losers. 5 words. Entire trading accounts saved or destroyed based on whether a person truly understands those 5 words. Because averaging down feels nothing like losing in the moment. It feels like patience. It feels like conviction. It feels like you are the smart money, the long-term thinker, the one who sees what others cannot. The market has a specific and painful way of correcting that feeling. The traders I have seen blow up, and I have seen many, sitting on trading floors in London, watching screens go red. Almost none of them were wiped out by a single catastrophic trade they knew was bad from the start. Almost all of them were destroyed by a trade they believed in deeply, that went against them moderately, and that they fed more and more capital into as it moved further and further away from their entry. They didn't blow up because they were reckless. They blew up because they were convinced. Conviction without a stop is just stubbornness with a margin account. The discipline to cut a losing trade, quickly, cleanly, without negotiation, is the hardest skill in trading. Not because it is technically complicated, because it requires you to be wrong in public, in real time, with real money, and to be completely at peace with that. It requires an ego that is small enough to step aside when the market disagrees with you. And most people, if they are honest, did not get into trading to be wrong. They got into it to be right, to feel smart, to win. The market will take everything from you to teach you the difference between intelligence and adaptability. Cut the trade, take the small loss, walk away clean, because the alternative is not a bigger win. The alternative is a much, much bigger loss, and a story you will be embarrassed to tell. Nobody sits down at a trading terminal and says out loud, "I am here because I need to feel intelligent." Nobody admits that. But watch how traders behave when a position moves against them, and you will see it written in every decision they make. The refusal to close. The rationalization. The sudden interest in fundamental reasons why the trade should eventually work. The checking of the chart every 3 minutes looking for confirmation that hasn't arrived. That is not analysis. That is a person protecting their self-image at the expense of their capital. This is the one nobody wants to talk about because it cuts too close to the bone. Trading attracts a very specific type of person. Intelligent, analytical, competitive. Someone who has spent most of their life being rewarded for being right. In school, in their career, in arguments around the dinner table, being right was the thing that defined them. It gave them status. It gave them confidence. It became, quietly and without them realizing it, a core part of their identity. And then they walked into the financial markets and discovered that being right means almost nothing here. Because here is the truth about trading that nobody frames correctly. You can be right about the direction of a market and still lose money. You can have the correct macro view, the correct technical read, the correct entry thesis, and still blow your account because your position sizing was wrong, your timing was early, or your stop was too tight. And you can be wrong about almost everything and still be profitable simply because you manage risk with discipline and cut losses without hesitation. The market does not reward intelligence. It rewards process. Those are not the same thing, and confusing them is a mistake that costs traders years. The need to be right shows up in subtle ways that are easy to miss. It shows up when you move your stop loss further away from price because you don't want to be stopped out. It shows up when you close a winning trade too early because you want to bank the profit before the market can take it back, locking in the feeling of being right before the feeling is threatened. It shows up when you hold a losing trade far past any rational exit point because closing it means admitting the idea was wrong, and admitting the idea was wrong means, somewhere deep down, feeling like you are wrong. The market charges a premium for that feeling. It charges it consistently, patiently, and without mercy. What the great traders understood, what the ones who lasted long enough to truly compound their accounts figured out, is that the trade is not about them. The trade is just a trade. It is a probability with a defined risk and a defined exit. It is not a referendum on their intelligence. It is not a reflection of their worth. It is not a story they need to win. It is a position that either works or it doesn't, and their only job is to respond to what actually happens rather than defend what they believed would happen. Detach the outcome from the identity. That single shift, genuinely made, not just intellectually understood but emotionally absorbed, is worth more than any indicator, any system, any course you will ever buy. Because once you stop needing to be right, you become free to do the one thing that actually makes money in this business. You become free to be wrong quickly, cheaply, and without drama, and right slowly, patiently, and profitably. Every trading book ever written spends the majority of its pages on entries. Where to buy, where to sell, which pattern signals which move, which confluence of indicators gives you the highest probability setup. And traders devour this information hungrily because it feels like the answer. It feels like if you can just find the perfect entry, the perfect alignment of conditions, the perfect moment to pull the trigger, everything else will follow naturally. It won't. The entry is the easiest part of the entire trade. I have watched brand new traders, people who barely understood what a pip was, stumble into perfectly structured winning trades. And I have watched seasoned, experienced traders with years of screen time take textbook setups and turn them into disasters. The difference was never the entry. The difference was always what happened in the seconds and minutes after the entry, the internal response to the immediate movement of price, and whether that response was governed by discipline or by emotion. Here is what actually happens when you enter a trade. The market moves immediately, sometimes in your direction, sometimes against you, sometimes violently sideways in a way that makes no sense at all. And in that first minute, that first 60 seconds after you have committed real capital to a position, your nervous system is firing at a frequency that your rational mind struggles to override. Your body does not know the difference between financial threat and physical threat. It reads risk the same way regardless of the source. And so before your analytical brain has had a chance to assess anything, your emotional brain has already formed an opinion and is already pushing you toward a reaction. That reaction is where accounts are built or destroyed. The trader who reacts to the first 30 seconds of adverse movement by closing the trade, not because the stop was hit, not because the thesis changed, but simply because the discomfort became unbearable, that trader will never be consistently profitable, no matter how good the setup was, no matter how well researched the entry, because they are not trading the market. They are trading their own anxiety, and anxiety has no edge. But equally dangerous is the trader who reacts to early positive movement by closing too soon, who sees 50 points of profit appear and immediately reaches for the exit because the feeling of having money on the table is more than they can psychologically sustain, who would rather lock in a small win than tolerate the uncertainty of letting a trade develop into something genuinely significant. That trader is also not trading the market. They are trading their own need for relief, and relief, just like anxiety, has no edge. What separates the traders who last, the ones who are still sitting at that screen 5 years from now, still capitalized, still sharp, is not that they found better setups. It is that they developed a response to uncertainty that is governed by rules rather than feelings. They decided in advance what they would do if price moved against them by a certain amount. They decided in advance at what point they would move their stop to break even. They decided in advance under what conditions they would add to a winning position versus close it. And then, this is the part that sounds simple and is anything but, they did exactly what they decided, even when every nerve in their body was screaming at them to do something different. The setup gets you into the trade. Your reaction determines everything that comes after, and everything that comes after is where the money actually lives. If you go back through the history of every trader who blew up an account, and there are more of them than the industry would like you to know, you will find a pattern that repeats with such consistency it becomes almost tedious. It was not a bad strategy that killed them. It was not a lack of knowledge. It was not even a string of losing trades in the conventional sense. It was one trade or one period of trades where the position size was so disconnected from the reality of their account that a normal, ordinary, completely unremarkable move in the market was enough to cause catastrophic damage. They didn't lose because they were wrong. They lost because they were too big when they were wrong. This is the conversation that almost never happens in trading education. The focus is always on the setup, the system, the strategy, as if the size of the position is a secondary consideration, something you figure out after the important decisions have been made. It is not secondary. It is arguably the most important decision you make on any given trade, because size determines survival, and survival is the only prerequisite for eventual profitability. Think about what excessive position size actually does to a trader psychologically. When you are trading too large for your account, and most traders are, almost all of the time, you cannot think clearly. The numbers moving on the screen are too significant relative to what you have. A 30-point move against you that should be completely manageable becomes viscerally threatening because the monetary value attached to it is more than your nervous system can process rationally. And so you don't process it rationally. You freeze, you hope. You move your stop, you do all the things you know you should never do, not because you forgot the rules, but because the size of the position has put you in a psychological state where the rules feel impossible to follow. Size is the variable that converts a disciplined trader into an emotional one. It does it every time, without exception, the moment it crosses the threshold of what that trader can genuinely afford to lose on a single trade without it affecting their mental state. The traders who last, the ones who are still in this business a decade from now, are almost universally conservative with size in the early stages. Not because they lack confidence, not because they are timid or risk-averse in some general sense, but because they understand something that takes most people years of painful experience to absorb. A small position in a good trade still makes money. A large position in a good trade makes more money, yes, but a large position in a bad trade can end your career. The asymmetry is brutal, and it only runs in one direction. There is also a subtler dimension to this that rarely gets discussed. Size amplifies not just losses, but also the psychological damage that accompanies them. A trader who loses 5% of their account on a bad trade can recover financially in days and psychologically in hours. A trader who loses 40% of their account on a single position carries that wound for months. It changes how they see the market. It makes them hesitant when they should be decisive and reckless when they should be cautious, because they are now trading from a place of damage rather than a place of clarity. Trade small enough that a losing trade is a lesson, not a tragedy. The market will always give you another opportunity. It will not always give you another account. There is a version of trading that lives in the imagination of almost everyone who enters this industry. It involves big calls, dramatic moments, the kind of trade that you tell people about at dinner, shorting the market the day before a crash, catching a breakout at the exact low, doubling an account in a week on a single position that moved exactly as anticipated. This version of trading is intoxicating to think about. It is also, for the vast majority of people who chase it, the thing that destroys them, because the market will occasionally give you that trade. That is the cruelest part. It will give you one moment of extraordinary return that rewires your brain completely, that makes the mundane, disciplined, process-driven approach feel small and inadequate by comparison. And from that moment forward, you will be chasing a feeling instead of building a business. And the market is infinitely patient when it comes to punishing people who are chasing feelings. The traders who compound wealth over years, not the ones who have a brilliant quarter and a catastrophic year, but the ones who are genuinely, durably profitable across time, are almost unanimously boring to watch. They do the same thing every day. They wait for the same conditions. They apply the same rules. They take the same size. They exit the same way. There is no theater. There is no improvisation. There is no genius visible in any individual trade because the genius is not in any individual trade. The genius is in the system, applied consistently over enough time for the edge to express itself through the noise. Most traders never get there, not because the approach is beyond them intellectually, but because they cannot tolerate the boredom. They cannot sit in front of a screen and do nothing when nothing is the correct thing to do. They cannot watch a setup that is almost right and walk away because almost right is not right. They cannot close a trading day with a small, unremarkable gain and feel genuinely satisfied with that outcome. The stimulation of the market, the movement, the possibility, the constant temptation of the next trade pulls them away from the process every single time. Consistency requires something that modern culture does not particularly reward or even recognize as a virtue. It requires the ability to be comfortable with repetition, to find meaning not in the dramatic outcome, but in the quality of the process that produced any outcome at all. To measure success not by the size of the best trade of the month, but by the regularity of the behavior that makes profitable trading possible across the month. This is what professional traders understand that retail traders almost universally do not. The edge is not a secret formula. The edge is not a proprietary indicator or a special data feed or a contact on a trading floor. The edge is behavioral. It is the cumulative advantage that accrues to the trader who does the right thing consistently in conditions that make the wrong thing feel more attractive over a long enough period of time that the mathematics of probability can finally work in their favor. Show up. Follow the rules. Take the boring trade. Go home. Do it again tomorrow. That sentence will never appear on a motivational poster. It will never go viral. Nobody will make a documentary about a trader who followed their process with quiet discipline for 7 years and built something real. But that trader exists, and that trader wins. Not loudly, not dramatically, not in a way that makes for a good story at dinner, but consistently, durably, and in a way that still matters 10 years from now when the account chasers and the thrill seekers have long since left the building.